Thank you everyone for joining us here today. Especially tough day to come because Germany played extra time. So very hard to wake up. But and also later 1 p.m. there's actually road closure. So be mindful of that because it's National Day. So by 1 p.m. there's going to be some roads going to be closed. So today we'll just run through our Singapore equity strategy. We have all our analysts are here, so everyone will just take turns to run through. So anyway, for the theme for this quarter, we call it seizing the yield. So as the picture suggests, what we're just trying to say is we think interest rates have peaked. The timing when you're going to get a rate cut, maybe it's December, maybe September, or even next year. But I think the core message is that interest rates are peaked. Economy is coming down, and as the title suggests, view is to seize the yield because these days some of the REITs are trading some 9% yield, some 8% yield. So that's why you have even a bull or a bear, you should be trying to catch the yield. Anyway, this is again, these days you can just generate any image you want, just type the words at the bottom. Okay, next page, next slide. So usual disclaimer, but let me just summarize for you. This is purely educational purposes. We took all the information we take usually from public sources. So we take information from Bloomberg, CIC, which is a paid service. So that's why some may not be able to get it, but we subscribe to all this. This is only general circulation, and of course, please seek advice from your financial advisor because this may or may not suit your investment objective. This is the same disclaimer every quarter. Next slide. Okay, just to run through what will be the agenda, we're going to do a review of what happened in 2024. Then we'll move on to some of the macro. Macro is, don't think of it like a forecast where we think, but we just want to set up the macro backdrop. So as an investor, you know what is roughly going on, and as you make your investment decisions. Zain will go through technical reviews. Our reviews, we try to cut it short. We give you what's the view of the Singapore market, one large cap pick and one small cap pick, and that's it. Then we changed it a bit. We used to do sector updates, then stocks, but no. So we combine both and we just run through investment themes. So it's like a menu. If you want to buy yield, so these are the names that we have. If you want to buy growth, so these are the names that we have. And then we will run through the usual model portfolio, how it's done, and so forth. And then we'll come up with the conclusion. Next slide. Okay, first one will be just a review of second quarter performance. So for second quarter, so these four pictures you see here is basically the index. The heavyweights are the large caps because there are like a few hundred stocks, you can't put everyone. So we usually just give you the best gainers, the banks, and how the REITs perform. So you look on your top left is basically banks. So banks did really well this quarter. DBS again, so second quarter of gains. And likewise, mainly because of the strong results that they reported this quarter. I think Glenn will elaborate more, and of course the high yield and they actually grew their dividends very aggressively. I think like DBS grew the dividends like 20%. So then the one that did well on your far right, on the top right, is basically the top three gainers at least on the index. So Yang Zhejiang, YZJ, we'll explain why. Part of it is because container rates. That means the freight rate. So if you want to ship something from China to US, which is the usual route, that spiked up almost 3 times, about 300%, mainly because of what happened in the Red Sea. So people thought that there'll be a major reordering cycle for containers. So that's why you see what YZJ did so well, almost 30%. But actually, if you look at Maersk, some of the shipping liner container rates, they also did similar kind of performance. Maybe not as good, but also like maybe 20% or more. No, those container ship companies. Then Sets and Jardine. The weakest ones were on your far left. I think the not very popular name, of course, Seatrail. We'll explain later more. You just give a slide on the sector. And of course, REITs, it was a very tough quarter for REITs. You can see the best performing REIT was actually CICT for the second quarter. Best performing means it didn't drop, so it dropped the least. I mean, it basically still dropped. And the worst performing REIT was actually Mapletree Logistics. So this is just a snapshot of what happened second quarter. Next slide. So that's for stocks in Singapore. We just move on to sectors or asset classes, we call it, like what asset classes did well in the second quarter. So that's in yellow or orange. And then in blue is year to date. That means first half. So congrats if you bought US ETFs, you are the best stock picker, because if you buy S&P, basically you bought all the large cap, and you also the best currency person because US dollar also did well. So if you did S&P, you're the best stock picker in probably beat 90% of fund managers, I guess. So if you look on the left, it's basically how the Singapore market, actually Singapore market was up about 3% this year, but because of the US dollar, so these are all in US dollar terms. Best performing asset class again is the US tech, NASDAQ, up almost 18% for the year, and worst performer is actually REITs, again about 15. And I think you can see then the far right is commodities, gold ETFs, bond ETFs, and so forth. Next slide. Okay, this is my last slide on performance. So this is just to give you a feel of all the performance of equity markets in the region, mainly Asia Pacific. So the best this local currency, just not. So the best performing was of course the top year to date. Taiwan did well. Worst performing country wasn't China, so it was actually Thailand. So quite a big feat to actually be worse than China. So Thailand was actually the worst performing market. Those that you see here like SG REIT, so these are some of the sub-sectors within the Singapore market. So SG REIT, REITs, and then FT, these are small cap names. So these are, and then Singapore is probably there like 3%, 2.9 for the year. This is local currency. Move on to the next slide. So we're just now going to run through what we see the macro backdrop for investors. Next slide. So the first one we think is that the US economy is still slowing down. Next slide. So how we view this is that if you, so like yesterday's jobs numbers was 206,000, but beneath the data is that almost 70% of all the jobs that were created in the US all come from government related. You're talking government jobs, you're talking about healthcare related jobs. So that's why it's very important these days for us where the US economy goes is where the deficit goes. Because the US deficit is going to be like 6% of GDP, which is huge. I mean, like Singapore deficit is 0. So basically, the government itself is injecting like 6 percentage points of growth into the economy. And the US economy is going around that level. So almost 70–80% of the growth, you could say, comes from the US government. So what we do see is that the US deficit is slowing down. So that's why we think one of the drivers for weaker economic momentum in the US is partly that. It doesn't mean we're going to recession, it just means that the rate of change is slowing. Next slide. Another thing that we notice is that US consumer discretionary spending is also slowing down. So one easy way to look at it is just auto sales, it's as simple as that. So auto sales did really well in 2023 and is starting to slide down as early as May and so forth. Next slide. So the other thing that worries us about the US consumer is this really obscure thing called personal savings rate. So the US measures everything. So this is basically how much does a typical US household save. So as the title suggests, what it just shows us is that they are really under saving. So they usually save maybe 8% of their income, disposable income. But right now you're sitting about 3%, it's almost all-time lows. So maybe partly because they had a lot of government stimulus. Second, you can see the spike up there. The government gave them a lot of money then, that's why their savings spiked up. But they're running it down. So that's one worry that the US consumer will be depleting. And of course, their household wealth have did really well with the equity markets doing so well. But what we worry is that if the savings rate normalize back to 8%, when you save more means you pull back on consumption. So that's why we think no risk of recession, but we just think that the slowdown, there is momentum and there are reasons why the US economy will still slow. Because consumers will be slowly pulling back. Next slide. Okay, this is my last slide on just the US economy. Again, not to kind of come and knock this theme too many times, but this is another indicator that which the one in shaded is basically during recession. So we're not having that big spike down. Why we use manufacturing is mainly because it's the most economically sensitive part. And what it does show is that things are just sluggish. It's not like exceptionally strong and all and so forth. Next slide. Okay, so the next macro driver we think will be important to investors is there will still be one rate cut, and we think that's going to happen in December. Next slide. Okay, so this is a very complicated chart, but anyway, this is probably a very important chart too, because this is the inflation. So this is the red line is where inflation is now. So this is the so-called PCE, and the green line is where the Fed wants it to be. The shaded part is if you extrapolate. So we are a bit worried that inflation might actually creep back up, but right now at 2.57 or 2.6 is actually below the Fed's own projection. So if you look at the shaded area, the table on your left, this is where the Fed is forecasting. So the Fed forecast inflation 2.8, and but right now it's already below. But the other key point to note here is, as the title suggests, is that apart from the inflation below interest rate, is that the Fed actually wants to cut rate. So why we say the Fed is really itching, I mean, probably like not the right word to use, but it's very eager to cut rates. Is if you look at their forecast, they think inflation will only hit their target by December of 2026. And even if you take 2 years to hit, they're ready to cut rates by almost 5 or 4 or 5 times. I mean, if you do the 3.1 right now, it's about 5.25. So they're ready to cut rates by 5 times, even when their target only reaches in 2026. So that's why we think, just based on their projection, we have a Fed that's very benign, really waiting to cut rates and just waiting for the data to just come off a little bit more, and then I think they're ready to go. And the one important message is that once the Fed cuts, they usually don't bring it up. So the whole market will take it as an indicator that rates have peaked and the direction is only down. Of course, the timing, you can't really like be specific about that. Yeah. Next slide. Okay, this is just for reference. So the blue line, again, another complicated, after that, no more complicated charts, but the blue line basically is where the market, in December, was where the market thought interest rates would be. So everyone thought the interest rates were just going to collapse. That means from 5.3, it just dropped all the way to 3.8. Then, of course, by May, it went up so much, then that's why all the REITs got hit, because everybody, now the interest rate expectations have changed from 3.8 to now 4.9. Sorry, to 5, but now it's about 4.9. So now the interest rate expectations kind of a bit more normalized. But this chart basically explains why the REITs were weak. And the one in the middle there, you see third quarter, fourth quarter, is just to tell you what the market expects. So the market expects like maybe almost 2 rate cuts, or 44 basis points, also roughly 2 rate cuts. But the Fed, that's one last point, is that if you look at this last on the far right, what we're just trying to show you is that even the Fed thinks that they're going to cut interest rates by 3 times by 2025. Of course, these things can move, but on their own projections, again, it's just to reinforce the message that they are ready to cut now, because they are forecasting at least 3 rate cuts next year. Next slide. The one country or one zone that has really cut is, of course, ECB. This is the same slide that we did, but they finally did cut. So just to explain the chart. So indeed, the red line is inflation. So one reason why the ECB cut so much is because inflation really collapsed for them. And their interest rate is, ignore the yellow line, that's more complicated. If you want to understand, that's more the real rate, but we won't go there. But the blue line is where interest rate. So you can see this little, unless you have really strong eyesight, you'll see the blue line start to dip. So in June, the ECB cut 25 basis points. Again, why we show this chart is because we have coverage on Cromwell REIT, and I think Darren will explain more. But the narrative right now is the ECB wants to do 2 more rate cuts. So they are the first to cut, and we think that they're going to be more aggressive. And of course, this will be beneficial for European-related assets. Can be your Cromwell REIT, or I'm not sure about iREIT, but anyway, that's why we show this chart. Otherwise, I mean, we partly look at Europe. Move on to the next slide. Okay, this one will be just 2 more parts. We'll just look at Singapore. Just have a snapshot what's happening in the Singapore economy. Next slide. In a nutshell, Singapore is just stable, not hyper growth. It's just moving sideways again. So no, Singapore is very reliant on exports. So this chart is just to show you the growth rate of exports. The blue line is basically the usual exports, and the red line is electronics. So it's not very encouraging, not like spectacular, but it's just growing sideways and it's not contracting as much or starting to turn up. Next slide. Okay, then again, another way to gauge how the Singapore economy is doing is to look at retail sales. Not very encouraging if you think about it, because retail sales now is growing at 2%. GST 1%, so you take that out, it's probably growing at only 1%. Which is probably in line with pre-pandemic. So no, Singapore retail isn't the most hyper growth area. Pre-pandemic retail sales in Singapore is probably like 1%. This data point is important. I mean, of course, we have retail REITs, and of course, we have also things like Singtel and so forth. So the blue line is just supermarket sales, just for your reference. But it's just a sign of where at least the local economy is going. It's about flattish. Next slide. Okay, then one last one on just on property. So property is really horrendous. I think so this blue chart that you see here is basically the trailing 12 months. So what you do is you take the last 12 months, all the property, new launch, private residential, excluding EC, because EC can make it volatile. But what you do see is that it's almost like global financial crisis, although we don't have one now, but the volumes are down right now, about 5,000. You should expect it to rebound. I mean, typically, even worse years after the TDSR, you still get like 6,000 units sold. One of the reasons, I mean, we do ask some of the agents, agencies, why is mainly there's a lot of delay in launches. Don't ask me why or who's delaying the launches, but there are delays. So there are delays in getting approvals for the new launches. So that's why the new launch is also weak. Not to mention the prices are expensive too. But that's one of the key reasons why it's weak. And the other reason is also, that's why the recent land bid, one of the reasons you didn't see much of a land bid was, if I'm a developer, I have 5 years to get my unit launched, to sell my unit before I get penalty. Usually it takes 9 months to get approval, now stretched to 1 year or more, then my runway is going to be very tight. It's going to be very risky. So we think that's one of the reasons that contributed to maybe no land bids. But anyway, this chart is important because real estate agencies will be affected, and also, of course, property developers will be affected. But we don't think it's going to stay at this level. We think they should rebound because there should be more new launches coming up in the second half. Next slide. Okay, again, we do get requests on what is Singapore valuations. So we are probably our PE now is about 11 times. We used to show this chart, but until it didn't move, it's always cheap. So I just gave up giving this chart. But anyway, if you want to know, it's attractive. Hopefully, hopefully the line go up, so I don't say it's attractive to go to average. But at 11 times, we are probably the second lowest in Asia after Hong Kong. But if you do statistics, this line should actually go back up. But anyway, but basically to show you, and I didn't show one more chart, but because of course some would argue, interest rates are higher, so shouldn't the market be here? But even if you add in the high interest rate environment, we are still trading at low 1 standard deviation. I know just the quartile of it, just for your information. Next slide. Okay, so the next driver, probably not this quarter, but following quarter, of course, will be the US presidential elections. I think our US team that we're presenting next week will probably give more, but I'll just give you a flavor. Next slide. So right now, so this is betting. So we don't really take poll because poll is survey, but betting is probably more important. People put money. So this is basically the betting average, who's going to win. So if you go to this website, Real Clear, or you go to Bloomberg, you can actually get it from Real Clear Politics, or we got it from Bloomberg. So basically, this means where the bets are, people put money, is like the Euro 2025, who's going to win. So everyone is betting that Trump is going to win, which is, I think the odds are very high for him, especially after the debate. When the debate happened, then you can see Biden's odds of winning just totally collapsed, and instead the vice president went up. But I think the other more important thing is not so much this. I think probably pretty obvious, who has the higher chance of win. I think the focus right now would be the battle for Congress. So I think the view of the market now has shifted to who's going to take control of the Congress. What we think, or I think more like what we guess, probably by August, September, the market might be a bit more quiet, because typically before you get into a presidential, people might a bit hesitate because you're not really sure who wins, and whoever wins, the policy impact on the US is quite, so people might be a bit more hesitant. So you might see a market that's a bit more hesitant in August to September, just before the November elections. I mean, this is 99% guess, but there's some logic to it. But the thing to watch is who's going to win the Congress. So if it's a divided government, that means a Republican president by Trump, then Democrat control Congress, then nothing happens, which the market likes. I mean, that they cannot do anything. But if it's all Republican, then there are some swings to it. Then it could be more tax cuts, more growth, but of course then inflation will be high, then the bond markets might actually come off, or interest rates will come up. So again, these are some of the permutations. Next slide. But of course, we're talking about Singapore market, so that one we leave it to the US to give you a Trump basket of stocks. But for us, the big risk for us is ASEAN. So why we say that is that if you look at this chart, so this is US trade deficit. So China used to have almost 400 billion of surplus. It's a negative number because it's a deficit for the US, but China used to have 400 billion deficit until Trump started to complain, then he imposed tariffs. Then you notice it collapsed quite a bit. Now, of course, pandemic happened, everybody need to buy stuff, right? Then it went back up. But the one thing that is up structurally is ASEAN. So ASEAN's trade surplus now is even higher. It climbed from I don't know 100 billion to now 200 billion. So if you go through his commentary by Trump, I mean, one thing he sees tariffs not just as a gain to generate income, I mean tariffs like taxes, but he also views it as a political leverage. So that's a bit worrying. So what it means is that on paper, at least he could say that ASEAN or especially Vietnam, you're so friendly with China, I'm just going to impose some tariffs on you because it's political leverage. We're not saying it's going to happen, but we're just saying that there's a risk. And of course, if that happens, then he's going to hit the Singapore market because he's going to, if he targets ASEAN, hopefully he didn't see the red line, he focused on EU because that's probably his first target, which is EU. But that's the risk to watch. I mean, if he starts targeting ASEAN and impose tariffs, then it's going to hit the Vietnamese exporters, Malaysian exporter. Then, if you want to buy anything on US for a Trump victory, I think better to just go straight to US, not to go and buy it through Singapore. Yeah. Next slide. So with that, I'm going to hand over to Zain just to run through some of the technicals.
Okay, thanks, Paul. Good morning, everyone. I'm Zain. I'm a technical analyst. So today I'll be sharing a little bit more about the technical outlook for Singapore market, our large cap pick as well as our mid cap pick. Yeah. So first up, outlook of the Singapore market. Some people say that Singapore market is quite boring, but this year, Singapore market has been doing quite well. SCI is up about 8% year to date, and then this week we also saw a new high for the year. Reaching levels last reached in over 2 years. The last time we reached SCI came to this level was about in April 2022. Yeah, so Singapore market has actually been doing quite well this year. Now, so I'll take a look at this ESG ETF if you are interested to trade the Singapore market. So in terms of chart wise, yes, we can see a strong bullish momentum. So first up, price has remained above the uptrend channel resistance since breaking out of the ascending triangle over here back in April, and we're still seeing a strong bullish candle this week. So in terms of our outlook for third quarter, I think Singapore market will likely to remain strong with this bullish momentum, with our target about 3.5 to 3.6. Then if you are curious about how far are we away, how far is the STI away from the all-time highs? This was back in 2007, about 3,900 points. So we're still about 15% away from the all-time record over there. Now, then for our large cap pick, we have SIA, no stranger, our national carrier. So for SIA, the thesis is that we see a bullish trend continuation happening. So in terms of the charts, previously after this earnings gap down over here in February, price went down to do a base over here. It did a consolidation, and then in February there was a breakout above the around 658 level over here, and then price entered into another consolidation recently in this wedge formation highlighted in blue. And then what's interesting is that recently there was a breakout over here. So we see that price is likely to extend this bullish reversal upwards, especially we have this earnings gap over here where there's no volume over there. So price can actually go up quite easily to fill this gap and actually retest the highs over here around $7.38. So that will bring about over 5.5% upside from current levels. So we think that is attractive for large cap pick. Then in terms of mid cap pick is Soilbuild Construction Group. So probably some of you might not have heard of this name before, but what this company does is that does construction as well as some civil engineering and project management works. I think it's interesting because recently there was a contract win recently. Volume has actually came into this stock. And then our thesis is that it will likely continue this bullish momentum recently with a bullish flag breakout. So yeah, this was when the contract win came in, then there was a spike in terms of the share price and volume. Then price did a consolidation recently, pulling back in this bullish flag. And then this week there was a break above it, also with the 5-day SMA crossover the 10-day SMA as well. So that likely indicates a resumption in the bullish momentum, also with the increase back in terms of the volume. So we see potential for price to actually do a retest of the recent highs at 11.8 cents, which gives us about over 13% upside from current levels. So we think that's one mid-cap pick to look out for in this quarter. Yeah, so that's it from me. I'll hand over the time to Glenn to talk about our first investment team. Thanks.
Hey, thanks, Zane. Yep. So I'm Glenn. I cover the banking and finance sector. So our first investment team is high dividend yield. So it's a bit interesting for the banking since it's the largest component of the STI as well as in the Singapore market. It's very big interest. So I'll be doing a few slides firstly on the banking sector. So moving on to the next slide. Yep, so just doing a quick overview of the first quarter results. So we're now heading into the second quarter results. I think it'll be during the first week of August. So just a quick review, we can see the first two lines, that is their net interest margins as well as net interest income. We are starting to see it sort of flatten off, so that huge benefit that they had when interest rates were suddenly it rose very fast, we're actually starting to see it taper off. So it's not really a decline per se, but more of a stabilization of their net interest margins and income. So what was the growth driver then, that actually boosted their earnings? And that would be their fee income. We can see, on average is around, I think, 15% increase. So the high double digits for the banks. And then this resulted as well in their earnings also growing at around double digits. I think the last line here that would be interesting would be the Common Equity Tier 1 or CET1. So that is their highest quality of capital. Basically, it shows how much the banks have to either make acquisitions or to give more dividends. And we can see that OCBC here is still the highest. I will go more into that later on the slide on OCBC. But both DBS and UOB are pretty close because they did their CT acquisitions, which has brought down this CET1 ratio. So they did spend some of their capital. Now moving on to the next slide. So there are three reasons, three themes as to how the banks can sustain their high dividends and whether or not their dividends can continue growing. Firstly is we're looking at their net interest income as well as the net interest margins to not decline but to stabilize into the rest of the year. I'll just briefly go through what this chart shows. Firstly, the blue bars there, that is the total net interest income for the bank. So I just added all the numbers for each quarter, and then we can see what is their growth like. And also, this is comparing against the average NIM, which is that red line there, as well as the Singapore interest rates or 3-month SORA. So that's the orange line. So from this chart, we can see that the net interest margins for the banks actually do follow quite closely to the interest rates. It's quite sensitive to the Singapore interest rates. So you can see it moving in tandem. But now that interest rates are flat, I think we are looking at net interest margins to also remain flat. And similarly, the net interest income has also been going teetering at these levels for quite a few quarters now. So going ahead, I think we do feel that the net interest income as well as margins will just maintain at these levels. So it won't really be a big mover for the banks, but it won't decline as well. Now moving on to the next slide, what is the second point we see on how the banks can actually sustain their dividends? And that would be the loans growth recovery. So with high interest rates, it's very beneficial for the banks. That's the headline news, right? We're all looking at it like, wow, look at their net interest margins. They have risen by double-digit basis points. But on the flip side, it's also a double-edged sword. So what does high interest rates mean for the banks? It means that their loans growth has actually taken quite a big hit. So we can see, from when in the 2022, mid-2022, the loans growth actually took a very big hit, mainly due to high interest rates where their customers and the consumers are actually unable to really take up a lot of loans because the interest rates are so high. And another reason as to why the loans decline is because there was also a big repayment of loans due to the interest rates where maybe consumers, individual investors, or even SMEs, they actually started to repay their loans instead of taking out more loans. So it's a double whammy for the banks. And then we saw it decline. But there's a good news for the loans growth is that recently we have finally seen some light at the end of the tunnel. The last 3 quarters, at least, it was the third quarter before this, third month before this, it was actually positive. This is the first time in almost, I think, 16 months that we have seen it turn positive. But interest rates haven't gone down. So what's the reason for that? It might be come to a case where the consumers are actually feeling it's they have gotten used to the high interest rate environment, and also they have no choice but to actually take up loans now in order to continue their growth. Yep. So we do see a loans growth recovery for the banks. We're looking at around low to mid single digit for the banks, and this will further contribute to their earnings going into the rest of the year. Now, moving on to the next slide, this is so lastly, the biggest, I think, growth driver for the banks would be fee income, right? We have seen fee income growing at double-digit levels the last few quarters. Explain a bit about this chart. Firstly, the orange line there, you see that is the fee income for the banks, right? You can see it's been from like almost record lows in December. Yeah, suddenly shot up to near record highs, I think, in the last quarter in March. And the blue bars there, and that's AUM. So that's asset under management. Asset under management has actually been growing steadily. So even though fee income declined, but assets under management has actually been stable or even growing. And you may be asking, why is that so? If your base is growing, like your funds are growing, but why is the fee income we are earning lesser and lesser? So there's a few reasons for this, but the main reason being that the products that the AUM is going into, the investors are choosing, is not really high yield. So they may be putting it into fixed deposits where the bank earns a smaller margin, or they might be just keeping it as cash. So they're not really using this to put it into investment products. But what we are seeing now, the trend is that investors, they're not really being able to park it into very high interest fixed deposits. Like previously, we were able to get above 4%, but now we're hovering around 3 and 3.5%. So what we're seeing is that investors are saying, okay, maybe they're putting on more of a risk-on sentiment, and they're going to higher yielding investment products, wealth management products. Hence, we are seeing this huge climb, as well as also contributed by another climb in the AUM as well. But once, we might be able to go back to, let's say, you go back to March of 2021, where you see the AUM is so low, but we actually managed to get such a high fee income. So that is the target that we are hoping the banks will be able to achieve. And we are also expecting around a double-digit fee income growth for the banks, which will further contribute to their earnings growth as well as maintain their high dividend yield. So now, moving on to the next slide. Yeah, we have 2 picks for the banks, 2 out of the 3. Firstly will be DBS. I think this is the name on everybody knows this bank, right? It's the largest local bank in Singapore. What is our team for DBS would be the highest dividend payout ratio. So comparatively to OCBC and UOB, their peers, the DBS actually does not report or does not have a dividend payout ratio cap. Unlike the other 2 banks, they are quite strict on the 50%. They say that we only pay back 50% of our earnings back in dividends. But DBS is saying, no, we don't follow that. We are able to go above that. And they've also the only bank that has given a very clear structure on how much they're going to increase dividends. So previously in their investor day, they said 24 cents per year, but they've actually surpassed that. They've not only further increased their dividends, but they've also given that 1-for-10 bonus share issue, which I think many of you have benefited from that. Yeah. And what do we see going into the future? As I mentioned earlier, the same things, we see the fee income being the main growth driver for DBS, but they're also able to surpass their dividend payout ratio. And this will actually make them be able to give back more to shareholders. So we are expecting around, I think it's around 6% dividend yield going to next year, but for this year we're looking at around 5.7% dividend yield for DBS. So moving on to the next one, OCBC. I might have bashed OCBC a bit before when I was talking about DBS, that they kept their dividend payout ratio at 50%. But what they do have that makes them stand out from the other 2 banks is that their CET1 ratio, or as I mentioned earlier, the Common Equity Tier 1 ratio, is actually the highest, and it still remains the highest amongst the 3 banks. You might ask, why are they hoarding so? So I'm also not very sure, because we always ask them, why don't you pay it back to shareholders, or why don't you make an acquisition? I think they have proven that, currently with Great Eastern, they have trying to make that acquisition to fully acquire Great Eastern. So they're spending around 1.4 billion. But even then, if they do proceed and that goes through, right, it only goes down by 0.6%. So they're still hovering around 15.6% post-GE acquisition for their CET1. It's still the highest amongst the 3 banks. And even so, just what difference does this CET1 make, right? So 1 percentage points, it's around OCBC, sorry, it's around $2 billion, and that can actually increase their dividends by 50%, right? So for them to match DBS's, the second highest CET1, they can increase their dividends by 50%. So we just hope, you know, that they are able to let go some of that capital, because it's really excess capital, and return it back to shareholders. They're really done trying to do the acquisition with Great Eastern. Yeah, but with OCBC, it's really a bit hard because we are very unsure of what they're doing, and they're not as generous, I would say, as DBS. But we still like it because there is some certain potential upside to dividends for OCBC. And I was speaking a bit about Great Eastern. Moving on to my next slide. So we have gotten quite a lot of questions on I'm not sure if some of you here are shareholders of Great Eastern or even shareholders of OCBC, but we have gotten some questions on what is the different scenarios and what should a shareholder do. So I'll just quickly go through the recent general offer that OCBC did for Great Eastern. For those who are sure of what this is, they basically made an offer at a share price of $25.60 for the remaining shares that they do not own, which is around 11+%. So what is the three scenarios that we are looking at going forward with this offer by OCBC? Firstly, so overall, they have already achieved that over 90% shareholdings of Great Eastern. So that means that the stock will most likely the trading will be suspended once the offer is the end date, which is 12th July, if I'm not wrong. So there are three scenarios we're looking at. First one is that compulsory acquisition, which means that they get more than 90% of the shares they do not own, right? And more than 90% of the minority shareholders actually accept this offer. So OCBC will have more than 98.8% ownership of Great Eastern. What will happen is that the trading will be suspended and Great Eastern will be delisted, and compulsory acquisition can be done for the remaining shares. We find that this is quite unlikely because there are some minority shareholders who are actually holding out. Second one, which is also another one, would be the exit offer, where if you remember in what happened to Boosted and their privatization, is where they had to give an exit offer to the shareholders who did not accept, right? So this means that they get more than 75%, but less than 90% of the minority shareholders actually accept the offer. So this means that they will have around 97.1 to 98.8% ownership of Great Eastern. And similarly, trading will be suspended and Great Eastern will be delisted, but this is only on the condition that OCBC gives an exit offer that is deemed fair and reasonable by their IFA, or independent financial advisor. So currently it's not fair but reasonable. And the valuation for this fair price will be around $28.87 to $36.19. Yep, so there is certain upside, we could get it coming in around $29 if we hit this 75% threshold. And the last one is if they are forced to restore the free float by SGX. And that is if they get less than 75% of the minority shareholders not accepting this deal. So this means that they will have less than 97.1% ownership of Great Eastern. So this is very uncertain or unclear territory, because we haven't really, I think no company has ventured into this new territory with the new conditions set out by SGX. So what will likely happen is that trading will also be suspended, and Great Eastern might be asked to restore its free float back to more than 10% so that it can remain listed. And this would mean that the share price could drop back to pre-VGO price of $18.70. Yeah, so that's all the scenarios. If later if you have any questions, you can just ask me if you're unclear about any of this. Yeah, so that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, I'm going to talk softly because I have an inflamed throat, so I don't irritate it. So hopefully you all can hear me. Yeah, so first of all, for high yield, we have REITs. So REITs is like a classic yield play for Singapore. So this chart basically just shows the height that the forward dividend yield for the REITs right now is trading towards the 1 step plus 1 standard deviation, which is above this is the 10-year historical mean. So it's slightly above the 10-year historical mean. Really, it's trading about 6.5%. So it's looking quite attractive. But that's mainly because of the share price that is already depressed quite a bit over the past quarter. So that is why it rose. not so much the fact that the DPU has been increasing. Yeah, next slide, please. Yeah, so this slide is the finance cost. So the finance cost grew from 2020 until 2023, and then there's I've taken the analyst forecast, the consensus analyst forecast for the finance cost over the next 2 years in 2024 and 2025. So these 4 REITs are the biggest REITs in Singapore: Mapletree Pan Asia, Mapletree Logistics, CICT, and CapitaLand Ascenders REIT. So as you can see, from 2020, the REITs, the interest finance cost is more than doubled already in 2023. So in 2024, we are expecting the finance cost to kind of stabilize, but at the higher rate, and to maintain around 2024 and 2025 to kind of peak around that level before coming down in 2026, as the REITs have already repriced a lot of the repricing of the loans have been done already in 2023 and perhaps 2024 as well. So yeah, the thing we want to say in this chart is basically that next year onwards, as interest rate has peaked, and with the slight growth in rental income that's possible, we can expect to see DPU year-on-year growth again starting next year. This year might be possible also, but because the full effect of the high interest rate has not been priced in yet, so maybe still flattish DPU this year. Yeah, next slide, please. Yeah, so I'll talk about our stock picks, or rather our yield, high yield plays. So first of all, we have Cromwell European REIT. So this is a European pure play European REIT with logistics, office, and light industrial assets. So as you can see, this I'll talk about this orange line first. So this line is actually the occupancy. It seems like it has dipped quite a bit, but actually it's not. So it's 95%, around 95% for the past 3 years. It is at 94% as in FY 2023. But if you compare it to some of the other overseas listed REITs, like the US listed, the line will probably drop into the Earth's core already. It's already 80%. So actually the growth is still quite stable for the occupancy there. And the thing that we want to highlight here is that even though the DPU is expected to fall because of higher interest rates, year-on-year growth, and because of the fact that they've already divested a lot of assets, they've divested about 270 million euros worth. So that will affect the top line as well because of the absence of the contribution of income. So they've done that mainly because they want to keep their gearing in check, like under 40%. So all this is to keep, they don't want to breach the gearing levels as seen as the US office REITs. Yeah, so they've done that, and as a result, we forecast our FY24 estimated DPU to drop to 13.76, and despite that, Cromwell at 13.76 cents is still paying about 10% dividend yield, which we think is attractive. And we think going forward with the ECB rate cuts, and I mean, we already cut once and possibly even more rate cuts to come, the REITs DPU will probably recover next year to 15.17, and therefore there's also done some redevelopment plans using their own capital money inside their own balance sheet, and that will start to come into play when it starts to contribute next year as well. So which is why the DPU we expect it to increase. And yeah, so that's for Cromwell. Next slide, please. Yeah, so for First REIT, we recently initiated First REIT yesterday only, in fact. So for First REIT, we like it because of its income visibility with a long WALE. So that's mainly because of their Indonesian assets. So their Indonesia contribution is from the hospitals. So from the hospitals, they have 14 hospitals that are on this lease structure out of 15. So basically that contributes to about 80% of their total rental income from Indonesia. Basically, Indonesia accounts for 80% of First REIT's total rental income. Yeah, so this lease structure basically is 4.5% of the base case, and every year they have this 4.5% escalation, and it's for 15 years. So this started in 2021, and you'll go on all the way until 2035. So the WALE is 11 years plus for Indonesian assets, and it's very, and the visibility is there of this 4.5%, and the further upside comes from the 8% performance-based rent if the revenue of the hospitals can hit that 8%. So basically, it's a higher off. So whatever the case is, first you will still benefit from this income visibility and stable rents. But the catch here is that the rents before this master lease arrangement, it was in Singapore dollars. So now after this restructuring that took place in 2021, the currency now that they receive the income is now in Indonesian rupiah instead of Sing dollars. So they will be exposed to this high FX or the weakening rupiah. As we've seen the rupiah already weakened year to date already about 4+%. So yeah, that is continues to be a headwind for them, but at least they have this 4.5% base rental escalation that they can bank on to kind of mitigate the impact. Yeah, next slide, please. Yeah, and as a result of the higher, the weaker Indonesian rupiah against the Sing dollar, our forecasted DPU also it falls to 2.36, but even at this 2.36, it still pays about 10% dividend yield. So first week they do try to hedge some of their income, but the thing is when you hedge the foreign the Indonesian rupiah is very expensive because we've seen historically Indonesian rupiah keeps depreciating against the Sing dollar. So yeah, they try to hedge 50%, and right now about 1/3 of it is hedged for until the end of the year. Yeah, so first week is still paying about a decent 10% yield, but the risk here is still mainly FX for them. Once they manage their FX, we think first week is a good play with a stable dividend yield. Yeah, and one more REIT for me. Next slide, please. Yeah, it's CapitaLand Ascott Trust. So instead of using our usual slide, which is a RevPAR growth, you all know we will likely still continue to grow this year as there are many events like the Euros, Olympics as well. And we've seen the RevPAR performance in Singapore for like the Taylor Swift Eras Tour. Imagine it happening all around the world, and they benefit because they have assets all around the world and basically benefit everywhere Taylor Swift is going. So other than that, we have this CapitaLand Ascott Trust. They have 300 million of divestment gains that are still sitting in the books. So if you take a look at this 300 million, it's actually more than the one whole year's distributable income. So let's say if 1 year they get zero income, they still can pay this, maintain their DPU at the current levels. But that's not to say that they will pay out the divestment gains. It really depends. It's up to their discretion. So this chart right here, it just shows the recent divestments that they made. And they've a good history of divesting assets at a high premium above book value. So unlocking value and getting some divestment gains as well. So which is why over the years, it adds up to this 300 million and they've kept it in the books. So going forward this year, we expect organic growth in DPU, and in the unfortunate situation where they cannot grow their DPU, they still can always top up to maintain at least flat DPU for this year. That's our view. So if that they are paying a decent 7% forward yield, so we think that's attractive as well. So those are our yield picks for Singapore. We still have one more OE REIT. I'll pass it to Mel for this. Thanks.
Thank you, Darren. Hi, I'm Mel, REIT analyst. So we initiated on your OE REIT last month. It's a diversified commercial REIT with majority of the income generated in Singapore. So here are some photos of their assets. They have 4 office properties. They all are AAA rated and located in the CBD area of Singapore. And their occupancy rate is all about 95%. And there's also 2 hotel assets. One is Hilton Orchard, that is just across street of the Apple flagship store. And another one is the airport hotel, it's Cromwell Plaza. It just finished the AEI end of last year. So they added additional 12 new rooms. Yeah, next slide, please. So we like OE REIT mainly because of three reasons. The first one is because of the very attractive valuation. So here's a table of comparison of some of the metrics among the 9 investment grade REITs in Singapore. So OE REIT has just been upgraded to investment grade REITs last year. Among the 9 investment grade REITs, they have relatively healthy gearing of 38.8%. And also they have the most discount to NAV. It's trading at more than 50% discount to its net asset value. So basically means you can purchase the asset with 50% discount. And they also have very attractive dividend yield of 7.8%. This is above the average of 7.1%. And secondly, we like the REIT because we believe the upside will be coming from the hotel segment. Hilton Orchard just finished its rebranding from Mandarin Oriental and had its full contribution in FY23. They used to cater towards the low-cost tour group, but now they shift the focus towards more of the corporate travelers, especially US customers. And now they are the only Hilton that is under the Apple's corporate list. And post-rebranding, RevPAR increased by 27%. And we forecast another 11% year-on-year increment in terms of RevPAR because of the muted supply of the middle tier to upper tier hotel, and also the recovery of international visitors' arrival. And downside of the hotel segment will also be supported by its master lease agreement. So this would yield around 6% of the dividend yield. And we also believe the earnings will be largely supported by the high rental reversion of both retail and office segment. In FY23, retail and office segment generated around 12% and 13% rental reversion respectively. And we believe the trend is likely to sustain and generate around 10% of the rental reversion in FY24. And they also have a very small portion of revenue exposure in China, which is Lippo Shanghai, but it's only 7.7% of the revenue exposure, so that is very marginal. However, we do expect DPU to drop like marginally in FY24, given the increasing financing cost. Yeah, but we expect a recovery in FY25 onwards. So we have a buy recommendation for the REIT and target price of $0.33, a dividend yield of 7.8%. Next slide, please. So moving on to the next theme, we have earnings growth. And the first one we'll talk about is China Aviation Oil. So China Aviation Oil is the largest largest jet fuel purchaser in Asia. And they also play a critical role in China's civil aviation industry. They are the only jet fuel supplier for Shanghai Pudong International Airport. And Shanghai Pudong International Airport is the second largest airport in China. So we identified two profit drivers for the company. The first one is from its associates. So profit from its associates mainly come from Shanghai Pudong International Airport. They acquired 33% of Shanghai Pudong International Airport. And like mentioned, they are the only jet fuel suppliers for all the aircraft departure from the airport. So in another way, they are the monopoly in the industry. And pre-pandemic, profit from associates accounted for 70% of the group profit. And here's a graph shows like the international air traffic. We believe that is highly correlated to the profit from associates, as the higher traffic volume, the higher demand for the jet fuel. So with air traffic increased more than 3 times, we believe profit for CAO this year would also double. It will double from 30 million last year to 60 million in FY24. And apart from revenue from associates, CAO also supplies jet fuel globally, especially to China, since China is one of the largest jet fuel exporters in the world. So with the uptick in air traffic, we believe trading volume will also increase, thus to boost another 30% of its profit. And we like CAO not only because of its visible earnings, but also because of its very attractive valuation. They currently hold 370 million cash in hand, and its market cap is only around 750. So essentially 50% of the market cap is made up of pure cash. And it also has a pretty discounted multiples. Its forward PE is around 7 times, and forward EV over EBITDA is around 2.9 times. So we believe it's heavily discounted. So we have a buy recommendation for the company, target price of $1.04. Next slide, please. So next we have Pan United. So this is an integrated logistic and infrastructure company. So they provided more than 300 concrete solutions. We believe this is another way to play the construction industry, as they occupy more than 40% of the market share in the industry. And we're particularly optimistic about the construction industry as it's a multi-year growth trajectory. Pre-pandemic, annual construction contract awarded was around 29 billion. And now we are seeing a 20% increment for the next 5 years. So each year we are looking at around 35 billion in terms of the construction contract awarded. And so it provides a very visible earnings for Pan United for the next 5 years. And this graph shows the demand for mixed concrete. It increased by 13% in first half 24. And we believe the momentum is likely to sustain for the next foreseeable 5 years. And by the end of FY24, we forecast revenue to increase by 12%. So we have a buy recommendation for the company and target price of $0.55. So I'll hand over to Paul to talk about Oiltek.
Okay, so this is a small cap company. I lazy to explain so much about it. So this is all text here. But anyway, so Oiltek is a small cap company. We hardly do small cap unless the growth is really strong. So one of the attractions for it is that they basically design palm oil refineries. And so if you see any refinery, any biodiesel plant, they are the leaders there. They are very well known in Malaysia. So that's the background. Why we like it, like all capex cycle, similar to a Satrum or whatsoever, we want to see, is there a major capex cycle coming up? So as you can see, we think there's a few capex drivers. There's more biodiesel blending coming up. Indonesia is taking the lead at 35% of the fuel or diesel has palm oil. Malaysia only has 10. So obviously they are looking to catch up, especially I think with the new administration. Then a lot of what you do see globally is that there was a bit of stalling in terms of expansion globally because of lack of US dollar, but that has kind of normalized. They haven't really expanded the last few years. But now we see that coming up. So they've also been capturing a lot of orders in Latin America, which is also expanding the palm oil. And the second reason is also there is a further downstream integration. So everyone not just want to refine palm oil, they want to use it for tocotrienol, for basically for medicine use and so forth. The big one, the big bounty, that's why we call it bounty, right? So it's SAF. So SAF is basically sustainable aviation fuel. It's virtually putting cooking oil into aeroplanes. Of course, they're not going to put so much, so don't worry. They're just going to put 1% first. But the 1% is huge. So you're talking about 51 million tons from 1 million because there's hardly any. So there's going to be a big ramp. What's happening is that if you look at countries like Indonesia and even the US, they view sustainable aviation oil really has to come from from plantation. So either soybean or palm oil. And they view it as a chance to take the lead. So a lot of oil and gas companies in Indonesia and also in US, they see this. I'm not saying they are OPEC, but it's a chance to take a lead, and that's why we think countries like Indonesia will take a lead, and this will give opportunity for someone like Oiltek. So they're one of the few that can actually treat. So this is palm oil. This is the waste. So any palm oil, usually there's a lot of pomade that comes out. Some of it might be added back in. Okay, I'm not going to go too much into that, but they're going to use it for palm oil. So we're going to expect. The other reason why we like it is because they have a very strong, they have a net cash of almost 131 million. The ROE is very high because the fixed assets is almost like a problem. The fixed assets is only 3 million ringgit or 1 million Sing. Because why they can keep the asset light is they don't do a lot of work. Just they do the design and they will outsource to all the contractors, and Malaysia cost-based so low. So that's why they have a high ROE, even though they have a net cash of 132 million. They're paying a yield of at least 5%. We calculated their EV EBITDA probably now forward that means how many times cash flow? It's probably like 1.8, 1.5, less than 2 times cash flow because they got so much cash. We have a target price of 70 cents. And the other thing is that the order book, I think move to the next slide. So the order book has grown about 50% CAGR for the last few years. They've also announced another record order. It's about 430 now. We think can hit 491. So we think it should still grow very strongly. But just watch for the SAF because if SAF come out, because SAF is talking about different ball game now. So for SAF, you're talking about a 800 million pound gorilla kind of projects because these are like oil and gas scale. Whereas most of the projects are like 20 million, 50 million, and so forth in totality, or even each fund maybe 10 million. So if that happens, this order book can just probably have to scale it up again. Yeah. Next slide. Okay, anyway, you can close your eyes. I have to say this again. I'm so sorry, but okay, but we still like it. Hopefully, just 1 more year, and then I'm not going to talk about this talk forever and ever. But there is still growth. Yeah, don't give up. Probably this is my 7th time talking about this. But we still see there's growth. Okay, I had to double check with the company. Can you please tell me there's still growth? But anyway, the growth coming from them is there's still, so for Singapore, you're still going to get platform fees they introduce. They're still going to get higher commissions. And because the taxi fares went up, so because their commissions is higher than, they take a commission off the higher fare, so they'll benefit. China is the one that surprised everyone. There's an upside surprise. Because in China, they are not a comfort. So in China, they just pure rent. So you don't call a comfort there because they don't run the taxi, but they just rent out cars. So pre-pandemic, they had 11,000 cars. Now they are probably 8,000. They're ramping back up to pre-pandemic. And even if you want to drive a Didi, which is their so-called Uber or the so-called Grab equivalent in China, you need the taxi because you need the license, because now they have to monitor, right? They will monitor all the drivers. So you need a license. So that's why there's another growth driver. UK contracting, after getting bludgeoned to death in their last UK because of because they had to raise all the recontracting, because you have to renew every 5 years. So that is also repricing upwards, and they got acquisition growth. The one that's weak is Australia, because again, recontracting swings. So that one, this time around, they're going to a weak recontracting cycle. And Singapore Rail, don't ask me why, but the profit there is really low. I think sub 5 million. I know the exact number, but I can tell you it's sub 5 million, but which is really pathetic considering you're running a MRT in Singapore. But because they're going to get a lag pricing, because when costs rise, you only get, provided the authorities give you the hike in rates only the following year. So that's still going to be weak. Okay, next slide, please, Pastor. Let's move on. Okay, any semiconductors? Okay, so semiconductors. So for the second, so there's only 3 semiconductors. We prefer the US ones, but anyway, so the 3 semis in Singapore is of course UMS, Franken, and AEM. So for second quarter, we think the results are going to be weak. So just hold on to your seats. Okay, but the coming quarters, we think there should be a rebound coming up, partly because of this. So why we show this chart here? So this is foundry capex. So foundry means that your TSMC, UMC. So this is our UMS customer. So if this thing don't go up, then it will affect UMS customers or these company customers, which can be applied, can be alarm research. So they sell their equipment to the foundries, and we think there's going to be a bounce in 2025. I think it's evident, and they're already guiding. So that's why we think 2025 should be a recovery year for most of the semiconductor names. The big hope, the one that everyone should monitor, is whether AI, also as we said, upside, is whether AI goes into the PC. So if you want to do a chat GPT now, you still take it from the cloud. So you can use a lousy phone, it doesn't matter. It's all coming up from the cloud. So all the infrastructure is built at the cloud, the data centers. So the one, if that really happens, if all of us start to buy a handphone because we can get better AI applications, a killer app in the phone, which nobody does now. I'm not going to upgrade my phone anyway. But if that really happens, and that's why we're watching this very closely, or then you're going to get a super rally on all the electronics. It's going to be a major upgrading cycle, a major rally for all the hardware. It's not happening. So I don't think anyone, we took to distributors because that's the best people to know, because all the Microsoft is going to promote this thing, AI in your PC, AI in your phone, AI everywhere in your shoe, everywhere. But the one to really ask is the distributor, because these are the ones going to sell these things. They can promote as much as you want, but when we speak to distributors, they are not very excited. They just say, well, you can use your phone, you can still get ChatGPT, so there's no real killer app. But it's something to watch, it's not happening. But in the meantime, you will see that the capex come up is a bit more nuanced, because for AI, you need memory, so there's a lot of memory capex upgrade and so forth. But anyway, we think next year is going to be recovery year. Next slide. Okay, but the controversy is that I'm actually we are broking Singapore stocks, but because we also do US coverage. So the reality is, who do you buy? If I don't have US coverage, then I won't show you this chart. I'll just buy Franken and UMS, although it's at the bottom here. I will delete the top 3 names here because so you cannot see. But because we cover US stocks, so to be fair, if you look at it historically, the best way to play semis has been the US names, which is their customer, or to buy the index or the ETF. So that's the reality, excluding dividend. So the title suggests, so if you're buying a ETF, a semi ETF, so you're just making a bet that the whole semi sector will rally. you're not going to make a bet on company because you do not know where market share change, right? You do not know who's going to win. Then you will take the bet on the index. You take a bet on their customers. That means the bottom two here customers like LAM and Applied, mainly because these guys are monopolies. Of course, they can't say that, but for certain parts, so like LAM Research is etching. So if you do the wafer, sorry, I mean, some may not know, but the round cylinder, like frisbee thing that you see every time, they make the edge. That means they actually drill the holes. It's not really holes, it's microscopic levels. So they are the ones who do the line. So wafer, let me just give you a brief explanation. Is you do a light, you put a light, you draw lines using light, then you have to dig a hole. So they are the ones who go and dig the hole. Then someone needs to coat the thing. So Applied Materials will do the coating, can be chemical, can be gas form of coating. But they are monopolies. So they have like almost 90% share, not 99, but actually 90% share on the very high-end type of etching. So people might buy them because they have monopolies. So that's one way to view it. But nevertheless, you can still buy Franken and UMS because equipment is still a very good business to do. So these two guys at the top here, they still make 50% margins. You can't beat NVIDIA, which is the fabless guys, because they make like 80%. But you can still play these two because there's still a huge profit and because they're all cutting edge. But we just want to show you this to be fair, because we cover US semiconductor names and you can listen to more. But generally, you have to figure out. I didn't include AEM. So AEM actually did even better than everyone, but of course it crashed back down to the same thing. But anyway, it was easier to view this. But again, this is just food for thought. But nevertheless, we are still positive on semis, but just watch for the weak results coming up. Okay, next slide. Okay, so this is my last one for marine. We talk about these two sectors and all because everyone likes to play these stocks. So this is virtually a Seatrium chart. Okay, so Seatrium share price dropped even though they have got 11 billion. So if I'm the management, I'm like, what else do you need from me? I mean, like, I give you 11 billion contract, you still sell my shares. But nevertheless, so the one difference of Seatrium now, which is your Keppel, I just put there on Keppel SMM order book. So this is the order book of Seatrium and Keppel. The red line is oil and gas proxy. That means what I did was I take all the capex plan for BP, SO, except Saudi Aramco, because Saudi Aramco don't have too far back. But you will notice that their order books spiked up even if the oil and gas capex, because they're getting, what I say ironic is that they're getting orders from oil and gas on the one side, so-called dirty, I'm lack of a better word, but they're still getting orders from the clean energy, which is renewable. So that's why they're getting this big jump, because like if you do an offshore wind, you still need something to collect all the power. So they do the HVAC, the very layman terms. But the thing to watch, we think we like Seatrium. I mean, it's hard to say that, as you can see, I'm stuttering here. Because the order books is high, usually you don't buy this kind of stock. When the order book peak already, you don't buy, you probably run away. But one thing to watch is really Dynamac. Why I say that is that Dynamac is almost similar because they do FPSOs. The results should be very strong. And if the stock rally means that people, when the good results come out, people still buy. So I think one thing to watch for Seatrium is the results should be strong with the order book. And there is still a few more FPSOs. It's like a banner year for FPSOs. So FPSOs, for those who do not know, are like a floating, when you want to, last time in the past, all the oil was extracted, processed on land. So now you do it in the deep sea, because no more oil, right? So you have to do deep sea. It's like a floating rig, in a way, a floating refinery in a way. So we still think there's going to be more orders for them because at least if you follow Seadrill's forecast, there's still but another 11 FPSOs every year for the next 2 years, next following 2 years. So we still think, ironically, we still think that there's still upside for the stock. I mean, it's down so much anyway. Next slide. So the other team to play, I mean, if you like geopolitics, next slide. Okay, but anyway, just to sidetrack, if you're really into geopolitics, you think doomsday, the best basket to buy is maybe long gold and short treasuries. But that's doomsday. I mean, if you think the directionally it's going to be wartime and so forth, apart from buying canned food, that will be the other asset to play. So for geopolitics, so when I mentioned ST Engineering, I mean, those who are long-term investors, their mind shut because ST Engineering share price never moved for 10 years. If you do the chart, of the last 3 years was good, but the last 10 years virtually did nothing. It just went sideways. Mainly because the earnings also went sideways. So the earnings was basically flat or didn't change for the last 10 years. But don't worry, we think there's hope now because you have a buy anyway. So if you look at this order book, so the order books, you can see why there's not much excitement. The order books has virtually gone sideways too, but we think the order books have started to climb. Part of it was, of course, due to TransCore, but if you exclude that, also the order books have started to climb, mainly because of defense. I mean, in part, you know that there's more and more conflicts around, so there's a lot of warehousing stocking up. But the other one that's doing well for them is also aviation. So they do a lot of planes, you know, when planes fly a lot, they need to do MRO, you need to maintain, right? Hopefully they do. I mean, I'm just kidding. I mean, most planes do. So because of that, you see the order books climbing up. The one on the right here, you see is just the quarter on quarter. So for the last quarter, it continues to hit record at 227. Their first quarter revenue was 18%. So you should expect earnings to be more than 18% in the first quarter because these days, SGX told all the companies don't have to announce quarterly results. So can chillax a bit, but anyway, but so they don't give earnings, but we think earnings is definitely better than 18% because there's operating leverage and so forth. There are a few reasons why there's also conversions of, there are a few drivers. Number one is defense, aviation. Third one is also conversion of freight, PTO, passenger to freight, but we don't run there. But in general, if you want to play geopolitics, we think finally, hopefully, they can break a new record in their share price. That's my target. Okay, next slide. Okay, so the other one to play, why Yang Zhiqiang did so well, one of the reasons is because of this chart. It's not a good chart if you order a lot of things from Amazon because this is the container rates. So container rates, if you look at the number there on the left, container rates actually tripled, because 200%, right? Basically it tripled from about 2,000 to 6,000. And because of that, because Yang Zhiqiang does a lot of container ships, people think that there's a major reordering cycle, or at least it lengthened the ordering cycle for container ships. So containers, you don't know, I think you just go to the yard in Singapore, you can see all those container ships. So what has happened is because of the Red Sea, it has taken the, people used to sail, I'm just making this up, I forgot the number, maybe 2 weeks, then now 5 weeks. So you need a lot more ships. This is actually a very good chart for banks. I think we mentioned this before because what it means for manufacturers is that they will need to have more inventory in the sea, and they will also need to have more inventory on land, which means good for banks, going to need to borrow more, right? Need more working capital. But of course, so hopefully that's also going to drive loans growth for the banks. But anyway, this is one of the things one way to play it. But of course, the flip side of having a Red Sea conflict is that this conflict can end any time. Then maybe these things start to drop back again. But again, this is just to let everyone know. That's why you have a neutral. Because if there's any sense that the Gaza conflict ends, then we're quite worried that this whole container thing could actually drop back down again. Just a warning, I guess. Next slide. Okay, we're going to do the last team now, which is value teams, which is a lot in Singapore, whole market all value. But anyway, no pun intended, Valuetronics. Now they're trying to do AI, mini-me. Okay, so why we like it, as the title suggests, is only 2 times EV/EBITDA. So EV/EBITDA means 2 times cash flow. And the market cap, they're still paying like 6% yield, and they are 80% of the market cap in cash. The earnings for the second half disappointed a little bit. We thought it would be stronger, but we're still positive on it. They recently announced plans to go into GPU as a service. Basically, there's so much demand for GPUs that people just want a data center just on GPUs. That means a data center just to run AI. No, in the past, all your data center got CPU, like to play all the games, which I do, from the data center. But right now, it's only GPUs. They're using China GPUs. We think it should do well because, but the near term should do well, but the longer term story for this GPU service is less known. But we like it because it's just so cheap. Anyway, next slide. With that, I'm going to hand over to Darren, who will just talk about some of the value names that we see, and then we can close it for Q&A.
Yeah, thanks, Paul. I'll just talk about CDL. So for CDL, it's considered one of our value plays. Yeah, mainly because the fact that the share price is now at 15-year lows. So the last time it was probably at these lows was at 2009, where it hit the first digit 4 point something Singapore dollars. Now it's $5.30 something. So it's not been at this $5 plus since for 15 years already. But the thing about CDL now is the fact that the property development segment is still very weak. It's mainly driven by the ABSD hike in April 2023 that we saw the foreign buyers, the ABSD hike to 60%. So as a result, you see in 2023, the number of units sold has fell to 5-year lows and unlikely to pick up going forward because the fact that this 60%, basically all the foreign buyers have already disappeared already. And in fact, in 2023, just before the announcement of the hike, CDL wanted to launch the Newport Residences. It's a freehold property. But because of the hike, they decided to push it back and it's still not been launched yet. It's still been delayed further. Yeah, and next slide, please. But the thing about value is that we do not know how low the value can be. Like you take a look at Hong Kong land. These are some examples of CDL's peers. Like for Hong Kong land, it used to be cheap at like 50% discount to book. So at that point, it could be value, but you see, it over the past 10 years, it dropped to 0.2 times. So it can be value all the way to 0.2. And we also don't know when the cheap value will be. So it's hard to call a bottom. But for us, we believe for CDL to really recover, it needs a catalyst. And perhaps interest rates could be one catalyst where the mortgage rates come down. It could benefit the loans as the demand for private properties come back to the market. So that could be one catalyst, or maybe even more interest rate hikes, or just some form of catalyst to really drive the price back to cheaper or lesser discount to valuations. Yeah, so that's for CDL. Next slide, please. Yeah, we talk about our last team. Thanks.
Thanks. On that positive note, anyway, in a way, re-rating is also quite similar to value because a lot of the Singapore, like a lot of the GLCs were also value until they did something about it, which is sell furniture. I mean, sell their assets. Next slide. So for re-rating, we still think there's one last run now. I mean, one last path of this. I shouldn't promote secret, but I mean, one last path. We think it's still going to come from Keppel because they're going to still recycle a lot of assets. So the catalyst is not going to be operational. So operationally, things are going to be flat. Like if you look at utilities, I mean, just a side note, I think for Semiconductors Industries, I think the earnings should be quite weak because two of their power plants are under maintenance. But that's already expected, but don't be surprised. I mean, just to let you know. But the main thing is that there'll be more like they're going to sell some of the notes. So basically, notes receivable was some of the REITs that they sold. They're collecting interest, but this is just paper interest, so there's no cash involved. So the key thing everyone is watching is that once REIT pricing and REIT ends are actually coming up. So REITs means I'm talking about all REIT, offshore oil rigs, which in the past like Keppel and all that did. So they have this bunch of assets, and once they sell that, they get the money. Then the share price should rally because they will pay back some of the dividends. The other thing is they got a lot of real estate assets in Vietnam. They got data centers they want to monetize, which is probably very valuable right now, especially the data center in Singapore. And of course, M1, yeah. I hope nobody asked me about consolidation. But anyway, the other thing is that these are all the assets they will run, and they have a target to grow by 2030. I mean, nobody is so patient. But anyway, there's another thing they want to do is to do the fund management, but I just put it up there. I think 2030, okay, thanks. We'll move on because everyone just waiting for them to divest. So we still have a buy on it, but it's just that, and it's in the model portfolio because we think there's still one more leg, at least this year, of monetization of assets. Next slide. The other one was Singtel. I know in many names, people all complain to me, Paul, you recommend Singtel, Stingtel, okay, but at least finally the share price went up. Okay, but there are three things why the thing is rallying. Firstly, operationally, they are actually lowering costs. So if you look at the cost cutting, we noticed that they actually did quite a heavy cost cutting. If I'm not mistaken, maybe in the 15 or 16%. Sorry, I don't have the exact number at the Optus level. So they had to cut. For Singtel, they have like Singapore, and then they have Australia, then they have associate stakes in Indonesia, India, and so forth. So they cost cut in Australia Optus because they will give a fabulous 1% return on assets. Like I said, I also want to run Optus because 1% is quite, I also can do that, 1% return on assets. But what they're doing now is they're finally doing a lot of cost cutting, about 200 million a year, so the market likes that. The second thing is higher prices. I think like you noticed India raised price. The share price did react because I spoke to our Indian colleague from India. They said that it was already expected 6 months ago, but the news only came to Singapore today. But okay, anyway. Anyway, so what's happening is that, but they're going to pay at least $1 billion. They guide at least minimum 1 billion in associate dividends. So that is also another driver. And of course, monetization. They committed to dispose of 6 billion of assets. I don't know, do like what Keppel did. The hidden thing, GPU as a service, that one is, they don't really guide. So this is my estimate or more like guesstimate. Because GPU as a service, if you do some rough numbers, like maybe $3 to $4 per kilowatt hour, you could hit this kind of big EBITDA numbers. So that's why you saw this big run in Singtel, and we still like it. Probably our target price is to revise because it's getting near. But the reason why there's room to move the target price is that if you do a sum of parts, that means if you do a value of all the associates, it's actually much higher than this. You're talking about maybe $4, but normally we put a discount on the discount. So there's a bit of room to move the numbers. Next slide. So this is the end of it. Thanks. You just go through the model portfolio. Not much change. We just ordered OUE REIT and we took out, I wanted to put the font smaller, but we took out Thai Beverage. The share price dip, we still have a buy. We think, we looked at the recent data, alcohol consumption has actually picked up the last 2 months, but when you have a D rating, it's very hard for it to return. It's only trading like 11 times PE for monopoly, so-called monopoly in Thai alcohol. But again, the market, so that's why we took it out, and this was the performance. So what hurt us was basically Keppel Corp. What did well was, I can't see it, but anyway, it's like Singtel and so forth. But this is just for reference. And the one that hurt us was Thai Bev, was down by 11 for the quarter, and of course, Keppel. Next slide. Again, this is just for reference. Again, this is historically, the blue line is, again, this is purely reference, illustration only, because we don't take into account dividends. And of course, we don't take into account any brokerage, which of course, Phillip is very low, so it won't really matter. But this is just for reference. Again, we underperformed this year, and most fund managers are probably going to underperform because the banks were the one that did the best, and most funds can't really hold like 40% of the fund in banks. So by default, a lot of Singapore fund managers are probably going to underperform too. I'm just giving an excuse. Anyway, next slide. Okay, anyway, in conclusion, we still see the US economy slowing. It's not going to collapse, but it's just a slowdown. But the funny thing right now is that bad news could actually be good, because if you're going to get the one bad news from the employment yesterday was that the unemployment rate crept up to 4.1%. So it depends how the Fed want to play this out. So the Fed might say, oh no, employment is getting weak, then they might give them room to cut. But so there's almost no negative news. So if it's bad, then it's just, the only thing is of course inflation. We think interest rates has peaked, that's why our strategy, and we see a lot of the REITs paying selectively, paying like 8 to 9% yield. So that's why we think it's a good time to capture or see some of the yield. We're overweight banks, REITs, telco, and construction. Construction, a bit surprised, like even he showed Soilbuild a bit, because we always thought construction probably the worst industry in the world for Singapore construction. But we're beginning to see a lot of awards starting to come. And second half, you're probably going to see the T5, the awarding of T5, which is, I think, all the terminals combined is probably only one T5. So there's going to be a lot more contracts awarded. So that's why construction has momentum too. Okay, I think thanks. I think we can move on to Q&A.
All right. Thanks, Paul and the team, for the insightful presentation. So right now, we're moving on to the Q&A. So we have questions from the floor as well as online. So for the online questions, we'll move based on the upvoted questions, 5 questions. For the floor, we also have 5 questions. So later, if you have any questions, do raise your hand. I'll move to you for you to say the question onto the mic itself. All right. So you have one question over there first, Awina.
Hello, my question is, I'd like to ask, what is outlook for EV manufacturer NIO, especially now with the European imposing a high tariff on EVs?
Okay, I think the research team, they don't cover the US counter, the NIO specifically. Yeah, so only the US team does cover that. All right, so we do have a US segment on the 11th, I believe, 11th of July, all right, evening. Okay, but for the new one, definitely they'll be impacted by the tariff of the EU market, all right, where the main thing is not only about the tariff, but also the competition that there is in China within their own country, the ecosystem, and also through the other markets. So the tariff from the EU, just to take note, is that it's not only affecting the Chinese car makers, but any car maker that's manufacturing within China. So even like Tesla, so their China factory there will be affected as well, right? As long as it's manufactured in China, it will be affected. Okay, so I think that's the thing.
The other thing to watch for NEO, at least from our own perspective, you can ask Jonathan, he covers the EV, is that because NEO, basically the risk of the battery passed to NEO, I think it's good as you're a passenger owner, because because NEO's model is to replace the battery. So if I'm a car buyer, I definitely buy from them. Like 10 years, I can just keep on replacing. But the risk then belongs to NEO on the battery. So that's my worry, whether this model is sustainable. Again, that's my own concern. And some of the interactions we speak to with some of the distributors for China, we do speak one or two. There's not many. They're listed here. It's very negative because even when Tesla cut price, so the volume didn't move. So some of them just gave up cutting price. The cut price is not going to move. And then it's just a bloodbath in China right now. It's like a knife fight. Everybody just killing each other. I mean, again, it's not a technical word. Everyone is just hemorrhaging. So I think for China in general, our big picture view is don't assume growth in China, but you play on consolidation. So not now for EV, because EV, there's still a big fight. But in general, we would, if you have to, our strategy for China, this is our own internal thing, is to look for companies that's going to do consolidation, because there's no more growth. But it's not at the EV sector. You got to look for other sectors. Yeah, thanks for the question.
Any other questions? Okay, wait a minute.
Thanks a lot. Can you refer back to the slide on OCBC and Great Eastern, the analysis of the 4 scenarios or the 3 scenarios? Yes, this is the one. So my question is that which of this scenario you think is likely to happen? Of course, I don't hold you to it. And my second part of the question is it true that if scenario 2 happens, then the GE stock will run up?
I'll go to scenario 2 first. Okay. So you asked if it's true if scenario 2 happens, will the stock run up? I think because by then what will happen is that we only know the answer on 12th of July, right? Like what will happen if scenario 2. So if that happens, then trading will be suspended. So regardless of anything here, right? The main thing what will happen with GE is that trading will be suspended. So the share price will just be whatever happens on 12th July. Correct? When the offer is finalized, because they already own more than 90% as of now. So it won't go down, it only go up slowly, but it's how much higher it will go. So it will probably not run up because it's really dependent on the last on 12th July, basically. So I think the main question people ask is like, what will the exit offer be if scenario 2 happens? So I would say based on historical what happened with similar scenarios, we will probably see it around $29 if scenario 2 happens. Yep.
So the first part question is, which do you think will happen?
So the first part of the question I go back to, if you look at the data of the shareholdings and how much people own, right? There's one big shareholder, I think it's the Wong family. They have around 3%, 2 to 3%. So if you look at this, that will make them own around less than 97%, right? If they do not agree. So I think the main question now is whether or not they can convince them to see how can they accept the deal. But they have publicly said that they are not going to do it if the current offer price is finalized. So it's very dependent on that party. If they do accept, maybe the rest of the minority shareholders will accept as well. So highly likely, number one, I don't think will happen, right? That will be very, very, very slim chance. So highly likely it could be number 3, But we are reaching this unknown territory where we have never ventured into this. SGX also has not ventured into this before with the new rulings and their regulations, right? So we're not sure what will happen. Will they really force OCBC or GE to restore the free float? Or what would they do, right? We have seen number two happen with Boosted, right? They got 75%, and then they told them if you don't give them an exit offer, you must restore the free float. So we have seen it happen. So number two and I think number three is higher chance, and number two is also higher chance depending on that 2 to 3% that they have. Yeah, that Wong family has. Thanks.
All right, we have one more question over here.
Thank you. I have two questions. The one question is why is there any reason that you removed the Thai beverage from the 10 absolute model portfolio? The second question is that what would be your views on the oil and gas sector, for example, like these REITs International and RH Petrogas? Thank you.
Okay, yeah, sure. Thanks. Thanks for the question. So for Thai Bev, so for Thai Bev, we actually took it out mainly for short-term view. We think 2025 is the recovery because what we think the trajectory, we think for the share price is that you will only see numbers improve in the third quarter because the volumes are only improving the last May and April. So we do see beer consumption. I mean, there is industry data. So there's only improving from May onwards. So what we think is when they release their September results, probably in end of this year, then you can see the numbers. So that could help take the rally up. Then the second thing is that Vietnam is also improving, so you see that. Then in next year onwards, they did say that if by early next year they might consider still do the beer co. If you're lucky, like if everything stars align, which usually don't, they may list it. If not, for beer co, they will do a stick sale. So they might do some realization of stick sale. So these are the two share price catalysts for them. The third one is Fraser's Property, which is another catalyst, which they consider it as non-strategic. So all these events we think will only happen next year. We don't think the next few months. I think sometimes our model is just very short term. So we just think that investors are still derating more. This thing won't move in the very near term. But in 2025, where you watch, so there's Fraser's Property, there's a BeerCo stick sale, not IPO, because nobody's going to buy 30 times PE, right? But because who's going to buy the BeerCo is a strategic investor that doesn't have presence in Southeast Asia. Could be a Chinese buyer, could be a Japanese buyer. Whether they pay 30 times, I do not know. Better, maybe they have to come pay a lot. But anyway, so there is a share price driver. Just in the near term, we don't see it that way. So for RH Petrogas and REX, I do not know what's going on in REX. I mean, seriously, they just make a lot of announcements. I probably got to spend like months to understand. RH Petrogas, we know it a little bit better because they do have briefings. There is no production growth. So when you don't have production growth or very challenging to have it, then the market will just view you as a proxy to oil price. Oil price, you are just being traded as an oil price proxy. Oil price go up, you just buy, oil price go down. But for them, for RH Petrogas, I think the near-term driver for them is that they are trying to develop a gas field. So to develop a gas field, you need money, and apart from Indonesian banks, most banks do not give funding. So for them, they are probably the next share price driver for them is to probably get an oil field connect to an aluminium smelter, a nickel smelter, or maybe aluminium, but because all gas is very difficult. Gas, you need off-taker. It's not like anybody, you can buy it, the traders will buy it off you, but for all, you need a pipeline, you need an off-taker. So that's going to be the capitalist. In the meantime, sorry, that's a very long answer. In the meantime, the oil price go up, these stocks will go up, oil go down. As basic as that. Yeah. Thanks for coming.
Okay. One more question over here.
My question relates to the semiconductor sector. I just mentioned about AEM. On your view on what do you think? Is it at the bottom, recovering soon when the semiconductor recover back? What do you think?
Yeah. Okay. We are quite positive. I mean, we have a positive view on AM, but not near term. Near term, I think the results is still going to still going to be pretty bad. I mean, they already guided. The optimism comes from new customers. They have quite a lot of new customers, and you just need time to ramp up these new customers. So I think just a very near term, most people only want near term. So near term is going to be weak. But having said that, they are very reliant on, of course, everyone knows us, Intel. But we do think from the supply chain, I think there's an ordering cycle happening for that customer. Just too much inventory. And they've been making headway, especially with memory customers and a new AI. There's only 2 AI players. So if it's not the big one, it's the second one. So we think there are new customers coming up for them. Yeah.
All right. So we'll have the last question from the floor before we move to the online questions.
Hi. Any reason for excluding UOB in the slides, and what's the recommendation and target price? Yeah, so for UOB, why we excluded it is because, there are a few factors. Like, as I mentioned, each bank has their individual uniqueness. So for DBS is that they have the highest dividend payout ratio. And then for OCBC, we do see some surprise or at least some upside to their CET1, where they have a possibility of paying out more. But you look at UOB, their dividend payout ratio, they're actually the most strict, right, among the 3 local banks. So they do say that they are not going to increase it. Right? Even before OCBC said it, they say 50% and that's it. Right? And their reasoning they gave is because they are SME bank and they need the capital to continue growing the loans, and so on and so forth. And then also their CET1, there's also not much upside because it's the lowest amongst, they spend the most with their CT assets. So that's the reason why, we see that UOB will continue to grow. We still have, I think depends on the current price, but we do have a buy call on it. I think, yeah, the rest has accumulated, but we do have a buy call on UOB because we see that their CT assets are actually helping them to grow their fee income and wealth management into other areas that they're not. They are predominantly a very big SME player in Singapore, right? And we see that their SME banking is very strong here. But in other parts like Thailand, we can see them actually growing stronger because of their, I think they're trying to push their app, and then now they have you can use the same app across all countries. So I do feel that for UOB, that is one of the things that will actually help them push their earnings, which could also help to push their dividends, if you think about it, because it's capped at 50%. Right? It's not going to be lower than that. Yeah. Thanks. I think we'll go straight to the online questions. I also have a few here for me. I'll take these 2 here concurrently because they're asking the same thing basically. Hi Glenn, after listening to your presentation, would I be correct to say that even if Feds cut interest rate, the earning and thus the share price of our 3 local banks may not simply fall in tandem, since loans growth may offset the drop in interest income? And then the second question is, OCBC seems to have higher NIM in latest quarter. Does this mean it will be impacted most when interest rates come down? Okay, so the first question, yeah, so you're right. Whoever is that listened to my, at least you got that. So that was what I was trying to say. That even if they do cut the interest rates, we feel that loans growth will recover, which will help them to push their net interest income up as well. So there'll be a bit of a balancing act, right? It's a very hard thing that the banks are trying to do, where they're trying to balance it. So that's the one reason. So we hope that the loans growth will offset the decline in net interest margins, and that will help them to maintain their net interest income. And secondly, which we did not include here, which would be fee income. So fee income is a big growth driver, we feel, for the banks, because we have seen double-digit growth, and I also slashed earlier the AUM, the assets under management. It has been historically increasing at really record levels, but we haven't seen that reflected into fee income. So the growth is slower than the growth in their base, which is the AUM. So we feel that, if interest rates do go down, and then, more investors and more of their customers having more of a risk-on sentiment, this will further boost their fee income as well as their wealth management products, and they could possibly earn even higher margins on whatever AUM they have. So 1 basis point move can actually drastically increase their fee income. And going to the second question about OCBC, it says that they seem to have higher NIM in the latest quarter. Does it mean they'll be impacted most when interest rates come down? I don't think they'll be impacted the most. If you look at OCBC, they are slightly more diversified because they have that insurance arm in GE, right? So that I don't think they will be impacted the most when interest rates come down. If you think about that, because they do have more segments. So it's just really how they play on their funding costs. So for banks, another factor that they look at for net interest margins, right? It's not just the top line, which what everybody sees. It's interest rates very high. But the other factor you look at is also how much must they pay the customer, right? So maybe OCBC may have the highest NIM because their cost of funding isn't the highest, right? So I don't think they'll be impacted the most. They should all be impacted relatively similar for all the banks, because we've seen it's all quite same, the Singapore banks. I think I'll hand it. Who's the second one? Will be for Darren, is it?
Yeah.
Okay. Yeah,
Yeah, I'll take the second question, then I'll hand it to Meow. Yeah, so the question is, the current high yields for REITs is due to the depressed market price or higher for longer interest rates and not increasing DPU. Yeah, that's correct. So what is your take on recovery of market price? So my take on recovery of market price is, first of all, looking back to the past year, we noticed that actually the REIT share price movement is very dependent on the expectations of interest rate cuts. So as we saw in December, the Fed were expecting perhaps 5 rate cuts in 2024. Then we saw the December period, there was a spike in share price. And after that, the expectations started to come down throughout the course of the year, like from January until now. So as a result, we saw that the share price, as a result, it was quite weak. So for me, I think the catalyst for market price recovery is really the expectations of more rate cuts, perhaps or earlier rate cuts or this year, and perhaps more rate cuts next year. So I think, like Paul mentioned earlier, next year is expecting 3 rate cuts, and this year perhaps one in December or one or 2 or so. Yeah. So that's for the market price recovery. And for profit, as I showed in my earlier slide, the interest expense slide, I think this year the profit will likely remain around flattish, and next year as well. But the effect will really come in 2026 when the interest rates, the cuts come in 2025 as they reprice their loans. So in 2026, I'm expecting quite a significant improvement in DPU. And the last part of the question is that most of the loans taken are fixed rate. So that is partially correct. So a lot of the REITs, they have about 80% hedged interest rate loans. But the thing is not that a lot of the loans are not taken on fixed rate per se. They are taken on floating, but they're separately hedged by interest rates, so through interest rate swaps. So a lot of the REITs, they like to match the interest rate swap duration with the loan duration, whilst other REITs, they don't really match. So for example, I'll just use First REIT as an example. Their loan, right, the next up and coming expiry is in 2026, but in fact, 1/3 of their hedges expire end of this year. So they will definitely benefit from any interest rate cuts this year or next year because of this hedging expiry of the hedges end of this year. Yeah, so that is really depends on the REIT and how long they decide to hedge their interest rate swaps. Yeah, I think that's all. I will hand over to Mel to answer OUE. Thanks.
Thank you. The question on OUE rate has the highest cost of debt. What is your view on that? So OUE rate has cost of debt of around 4.3%. And we believe there will be another increment of 30 basis points in FY24. They are among the higher tier, but we believe from next year onwards, they will begin into the downward trajectory, mainly because of 2 reasons. The first one is they only hedge 66% of the fixed borrowing. So we believe at least there will be 1 rate cut by 2025. Yeah, so we'll probably see a decrease in cost of debt next year onwards. And they don't have any refinancing to be done in FY24. And they do have a large chunk of cash to be refinanced, debt to be refinanced in FY25 and FY26. So with the low fixed portion of the debt, we believe cost of debt will decrease in FY25 and FY26. And also they just upgraded into investment grade rates. So their cost of borrowing for the most recent refinancing was around 4.1%. This is even lower than when the pre-Fed rate hike, there was 4.35% for OIE rate, but now it's only 4.1%. Yeah, so it just their balance sheet position will be strengthened from next year onwards. And the next one, could you explain what is the investment grade rates and how are they different from the other rates? So there's mainly 3 criteria for REIT to become investment grade rates. The first one is gearing. So OIE rate has a relatively healthy gearing of 38.8%. Yeah, so that is below 40%, as market generally penalize REITs with gearing above 40%. And the next one is they'll say the debt maturity, like how lengthened it is. For OIE rate is pretty much like well spread. They don't have any refinancing risk in FY24, but they do have it in FY25 and 6. And the next one, the last one will be, let me check. Their decreased reliance on secured debt. Yeah, so OIE rate just change a lot of the secured debt to unsecured. Yeah, that's why they have been upgraded into investment grade rates. Yeah, I'll hand over to Darren.
Right, so we will end off the online Q&A from there. So we do have another sharing from our CFD team on their what they have to offer for you. So do stay tuned in a moment.
A lot of the secured debt to unsecured. Yeah, that's why they have been upgraded into investment grade rates. Yeah, I'll hand over to Darren.
Right, so we will end off the online.
So hi everyone, this will be the last segment. So after this, don't worry, you all can go have your tea break.
What they have to offer for you. So do stay tuned in a moment.
So hi everyone, so my name is Sam. I'm from the CFD Central Dealing team. And today I'll just share with you 3 very fast things. This won't take very long. It's about how every investor wants, which is the control, how you are able to control your portfolio, risk management, and also improving our efficiency. So a bit of a disclaimer, okay. So I personally believe that everyone in this room has an edge, be it from the year of experience that we have been in the stock market, be it our profession. Everyone has a different kind of profession, and also how we are all staying informed through reading the news, going to SSP like here in this event where professionals and analysts are sharing all the informed information with you, and of course everyone reads some news and also macro and micro news as well. Then because of that, right, we all know how our portfolio react to the news. Be it, the Fed gonna teasing us on whether they're gonna drop interest rate, cut interest rate cuts, elections, and so on. And as a long-term investors, like most of us here, we are always bullish in the long run. So we are not worried where the stocks will be in the next 5-10 years. But in the short term, we have mixed views. In the short run, stocks go up and down, and there are always times of volatility, and so we may have some even some bearish kind of views in the short run. So have you ever said this to yourself? I think one of the counters I'm holding is likely to go down due to be a bad earning report from a competitor, or be it from a macro news, or there are too many uncertainties that I'm worried, especially during COVID times, or even now when we are bombarded with news from good, positive, bad news, and sometimes even bad news is good news, especially in the US sense, where everyone is celebrating when it's bad news because they predict that the Fed most likely going to cut rates sooner. So on top of that, you also may feel that certain companies' prices are overpriced, maybe because of recent market movements, while going up 10-20% a short duration, or be it the fundamentals have not catch up with the share price. or investors or market participants has been pricing in too much good news. Or you could have a huge conviction on a counter that you've been researching and looking into, and then now that you find that, wow, this catalyst is going to really project it upwards. And as you all know, the worst feeling for investor is not that you are right. It's that you are right, but you have a view and you're right, but you didn't take action. Or you don't know how to take action. So as investors, we want to gain the ability to control and adjust our exposure of our portfolio with ease to reflect our view. Because our views in the short run can be, up and down. We want to be able to control, especially our main portfolio, be it increasing our exposure or even reducing our exposure based on our views. Especially after today, maybe you have some investment ideas that you want to try, but you don't want to adjust your long-term positions too much, but you want to take on some short-term positions to reflect your view, be it reducing your risk through hedging or even increasing some of your position size because you hear what you like and you feel that you agree and you want to be more bullish. So you want to take charge, the ability to take charge of investment, especially in volatile times, especially during COVID when everything is crashing, being able to sort of close out your positions without selling. So having a lower net exposure so that you can sleep better at night and not worry so much about the markets because you are able to control your exposure. Next, as an investor, we know that we should broaden our investment universe. So not just look into equities, we can look into other asset classes from commodities to FX, as what Warren Buffett said. A quote from him, the best investment you can make is investment in yourself, and the more you learn, the more you earn. So we should always expand our horizon and not just be limited to what we are comfortable with, but be more open to what are the other possibilities outside. For example, some of our clients have used gold to improve their risk versus reward, as gold is traditionally an asset that is negatively correlated with the stock market. So you can improve by adding certain percentage of gold into your portfolio. You can actually improve your risk versus reward ratio for your equities and your main portfolio. On top of that, one famous nowadays as interest rates of US is quite high relative to other currencies. Like for example, US dollar, Japan yen. There's a new strategy that's like FX positive carry trades. So clients have been holding US dollar, Japan yen, has been enjoying positive swap points of about 0.18% as of 24th June. Every day these rates fluctuate, but as of 24th June, it was this. Next. And lastly, as an investor, we will want to improve our efficiency. So leverage is a very, very dangerous term, or a term that a lot of people associate with high risk. But to me, leverage is the ability to do more with less, and only requiring smaller position size to effectively hedge your bigger portfolio. And it's a great way to gain access to harder to access market, especially when the prices are very high. To me, I would describe leverage like a F1 car. So if you allow a new driver to drive an F1 car, they are more likely to crash. But with the correct knowledge, skills, and also risk management, an experienced driver can really push the F1 car to its fullest potential, just like leverage. So I believe that with the proper risk management and discipline, leverage is the advantage that comes with CFD. So in conclusion, if you want to hedge your position with ease, manage your risk how you want it, turning your trading ideas into positions, be it you believe that certain companies are going to outperform and certain companies are going to underperform, diversify into different asset class from index, FX, commodities, and we are always expanding to offer more asset class and the ability to do more with less, then contract for difference is for you. So actually, we have a booth behind our CFD booth, and if you have gotten our tote bags, inside there's a leaflet with more information. So of course, you can refer to it and ask us any questions behind. And just for a promotion for today, if you were to open a CFD account with us, which doesn't cost money and it doesn't cost any fees, you can receive a $10 Starbucks gift card. And on top of that, if this is your first CFD account with us, then there will be free CFD contracts. So if you open a Forum CFD account, you'll receive a Palantir CFD. Then if you decide to trade up to 1.5 million in CFD contract value, you'll receive a TSMC CFD on us. And lastly, if you trade up to 4.5 million CFD contract value, then you'll receive a Microsoft CFD. So this promotion is until August, end of August. Then, yep. Then if you have any question, feel free to talk to us behind. Thank you very much.
All right, thanks, Sam, for the sharing of the CFD. So if you're interested, do look for their booth to open the CFD account. And you can also get a Starbucks card like he mentioned. All right, if you open the account today only, right, next time they don't have. So the rest, we do have some refreshment at the back. Do queue up in an orderly manner. All right, there's enough for everyone. Please do not rush. All right, so you can have your drinks and bento at the back. Do put the rubbish into the trash bins that will be located around you. All right, do not leave it around on the floor if possible. Thank you. All right, thank everyone once again for joining us this Saturday. And hope everyone have an insightful session and have a great meal behind later. Thank you. All right. So you can have your drinks and bento at the back. Do put the rubbish into the trash bins that will be located around you. All right. Do not leave it around on the floor if possible. Thank you. All right. Thank everyone once again for joining us this Saturday. And hope everyone have an insightful session and have a great meal behind later. Thank you. All right. So you can have your drinks and bento at the back. Do put the rubbish into the trash bins that will be located around you. All right. Do not leave it around on the floor if possible. Thank you. All right. Thank everyone once again for joining us this Saturday. And hope everyone have an insightful session and have a great meal behind later. Thank you. All right. So you can have a bento at the back. Do put the rubbish into the trash bins that will be located around you. All right. Do not leave it around. Thank you. Thank everyone once again for joining us this Saturday. And hope everyone have a great meal behind later. Thank you.